Well, the president pulled out the big guns today. We now have a 50% tariff on imported aluminum from Canada as well as steel. Well, does it matter? We're going to get into that today, and we're going to get into the realities of what happens in a tariff war. Many people have written me concerned about 401ks and retirement plans and equity accounts, stock accounts, things like that. When will it end? When will it end? When will we end? When will it end? We're going to touch on some of those things today. Stay with us, and if you're not subscribed, subscribe and hit that bell for all notifications. I'm very gratified that people seem to be enjoying and getting some benefit out of these podcasts. Forewarned is forearmed. And a very good morning to you. We're going to turn our attention away from social and protests, which is going to be a critical marker of what happens in America going forward, and the discussions about how a nation that has become super enabled on government, super dependent on government, I should say, is not going to be an easy transition to a future of less. And well, that's one of the real downsides of becoming dependent on government. But today we want to turn our attention because this morning I awoke and saw that the tariffs on Canadian aluminum had been increased to 50% as well as steel. This is really important. We're starting to get down to the real heavyweight punches are coming in now, because we use about 5 to 6 million metric tons of aluminum per year in the United States, most of which is consumed in the aircraft manufacturing as well as the automotive industry. Aluminum is a very strong lightweight metal, therefore it has really important uses not only in aircraft and keeping them light, but also in automobiles and lightening the weight and making them more fuel efficient. The 5 to 6 million metric tons used per year. Of that amount, 3 million metric tons comes from Canada. In other words, if we use 5 million, then 60% of the aluminum we use is imported, and we import about $20 billion of Canadian steel too. Now we're finding out that these tariffs, people never really, and it's not a fault of anybody. I mean, people never really studied or understood or even had any contact with tariffs before. Only if you were involved in economics and business and studies and things like that, or maybe a very detailed financial history of American things like that, you would know the history of tariffs. And well, the thing you got to know at the end of it all is they end up being removed or reduced back down to where they were before. But boy, is there a lot of pain to go through in between. And now the average person in America is starting to realize and starting to feel this pain. And somebody asked me, if the election was held, say, next Tuesday, right, do you think that President Trump would win? Well, I think it would be a very tough call to say that he would win an election. But on the other hand, people can say, well, we're in a period of transition here in America. And of course, with all the changes that are being wrought and with all the radical potential reduction and reducing of the federal government, and also now there's some trickle over to state and local. We've talked about it in local schools and things like that, as there are less students, colleges and university. It looks like a future of less. And as I said in the beginning, that's going to be a very, very hard adjustment for people. I always try to take a close look at financial markets, because they really are on the bow of the ship when it comes to looking forward. Because if you believe that smart people get inside information and therefore they're in the best position to make decisions about what to buy and sell to make investments, well, then you have to believe that people see what's coming ahead. Smart people know what's coming down the pike, and they act accordingly in the markets. And that's certainly playing out. Some people have said to me, I've seen no effect on, I've seen no effect on me so far, right? I mean, everything's, high five, everything's good, brother, everything's looking good. It takes a significant amount of lag time, usually somewhere on the order of 6 months, until what happens in the financial markets, particularly things like the stock market, begins to be reflected in the real economy. Because, well, the average person's not looking ahead with like the person that has a lot of money and a lot of resources is, to have good advisors and good information about what's going on. All this is to say that there's a lot of moving parts on the board right now. There's a lot of things that aren't. I noticed today that in the face of this persistent decline, that the 10-year yield on the bond, the 10-year loan to the government, has not moved down in yield at all, and as a matter of fact, has climbed from about 410 up to about 425 or so. We really need to keep an eye on this, because this tells us that during this rout that's taking place in the stock market and this persistent, consistent, and insistent decline we have here, that people aren't as much rushing to bonds as they would be in the past. And in fact, interest rates look like they could potentially rise back up to the highs again. In addition, we have gold and silver that, instead of swooning and falling over with all the selling, are holding firm and fast and holding their ground, and even, like in the case of silver, rising a little bit into this. So they're all sending signals. But the question that people have is, when will this tariff stuff end? Well, here's where we have a really difficult issue, right? We don't really know here. Like, people think that we put the Smoot-Hawley tariff that was signed into law by President Hoover caused the crash of 29. Some people mistakenly believe that. Right, the crash of 29 occurred in October, and it didn't find an initial bottom until about the middle of November, and then went on a 50% rally until April of 1930. But here's the deal. Herbert Hoover did not sign into law the Smoot-Hawley until June of 1930. That's a full, 8 months after the crash. So here we are looking at the markets now that are plunging and trying to figure out cause and effects and other things here. We know people's purchasing power is very impaired right now. We know the credit card debt among personal borrowers is at an all-time high. We also know that automobile loans are, they're the most in default that they've been in the recorded history of the automotive industry. All this does not bode well for consumption. It does not bode well when you have to import and use, and aluminum is more expensive. It may benefit Alcoa aluminum in the short run, but not at the expense of declining demand in the automotive industry. And if a truck is $50,000, $90,000 now, $140,000 fully loaded, right? The automakers have to trust that, the people are going to be willing to absorb, just in aluminum alone, right, a couple thousand more dollars at least on the price of an automobile. Not to mention how many aluminum cans are used in the beverage industry. It just goes on and on, aircrafts and things like that, and steel. So right now the market is saying, it's not going to work out so good, right? It's not, the profits aren't going to be astounding here, because what the companies like Alcoa and U.S. Steel make up for in higher price being able to charge for their product in the United States, they're going to lose on the demand side of the equation, which with much less demand for steel and aluminum, and well, it probably nets out to zero change, or possibly even worse. The markets right now are saying worse. You know, people say, are we crashing or something like that? Crash has several characteristics that I'll just mention lightly here. Consistent. We certainly have consistent selling. It seems like every rally that the market attempts to make is met by being capped or having people selling into it. Consistent, right? Persistent. There's just doesn't seem to be any turning around. There will be, of course, but you know, there's a persistency here that we rarely see in market activity, and insistent. Right? Insistent, persistent, and consistent. We just see people that are just bound and determined to sell on the way down. This is kind of an unusual situation. So, my own thought is we've definitely broken the back, at least in the short term, for this long-term bull market that's been underway since August of 1982. The question is, does a correction turn into a full-on bear market or a recession? I would say at this point in time, based on what we're seeing in technology stocks and the slowing demand and the bubble bursting in AI and the reduced ability of people to consume, we're going to see a massive pullback in luxury, that shell of luxury that I talked about. Less people taking Uber, right? Less people ordering meals in, less people having groceries delivered, less people taking cruises, less people going on vacation, right? If you fall too far too fast, you introduce a fear factor in things, and you start to introduce what's called the paradox of thrift. Something that we study in economics that's very hard to defeat once it's underway. And we had the lost decades of Japan from the through the 1990s, 2000s, and 2010s, where as things got bad, people were naturally inclined to become more thrifty, which accelerated the contraction, right? And it finally ended up getting things down to a base level of need by 1932 in America, right? Right? It was just a hard scrabble existence, and it was just a fact of economics. The tougher times became, the more thrifty people became, and the more the economy would spiral downward as a result. If we get locked into a paradox of thrift, it'll be something that's not happened for almost 100 years here, right? And the damage will be incredible in that regard. And well, we may not have the federal government borrowing to be able to bail us out and stem the tide and stimulate an economy. And this is my big fear that I talked about for years on here. We can hope and hope for the best, but plan accordingly. Well, I've talked about all these things that are finally coming home to roost now, and I don't want to sound like Alec Baldwin and Glengarry Glen Ross, but do I have your attention? Do I have your attention now? Right, remember the famous scene, always be closing. First prize is a Cadillac Eldorado. Second prize is a set of steak knives. Third prize is you're fired. Right? It's like, do I have your attention? Do I have your attention now? These, of course, are not humorous times. They're very tough times. There's a lot of stress going on. People are seeing years of investment success being unwound here in the markets, and it's highly possible that far worse lay ahead of us here. We just have to see. It's far easier to destroy an economy than it is to build one. It takes much more time to lay a groundwork for a new economic order than it does to destroy one. So it's a good chance for me to pitch and say, if you're not subscribed, please subscribe and hit that bell for all notifications. We don't just take a top-level view of things. Try to go in depth here. Go a little deeper in here. Mesh psychology with economics, with politics, right? and try to make sense of it all. And I would love you to be a part of it. So if you're not subscribed, subscribe and hit that bell for all notifications. And of course, I welcome your comments down below, right? Are you one who thinks, well, we got to break a few eggs to make an omelet? Oh, don't even mention eggs, right? Or we're just going down the road of unmitigated disaster. Well, just remember this, every civilization through history rises and falls accordingly. So it's going to be a very interesting future. Thanks for watching, everybody. Your comments are welcome down below, and have a wonderful day.